BTC USDT liquidation heat map from CoinGlass. It visually represents where high amounts of leverage positions, both longs and shorts, will be liquidated if the price hits certain levels. Horizontal green or yellow bands are areas of large liquidation clusters. Many stop losses or margin calls will trigger there. These are potential magnet levels. Price is often drawn to these zones to trigger liquidations. Market makers or whales may push price to hunt liquidity. Currently, May 27, 2025, if Bitcoin reaches the $115,000 level, the liquidation heat map shows a bright green to yellow zone, indicating a large number of short positions are likely to get liquidated. This means many traders who are shorting Bitcoin could be liquidated. On the other hand, if Bitcoin falls to $93,000, the chart shows moderate green areas, suggesting that long positions may start getting liquidated. These zones represent over-leveraged buyers who will be forced to exit their trades if the price drops further. The heat intensity is lower compared to the $115,000 zone, meaning the impact might be less dramatic. The liquidation heat map strategy is a method of analyzing market sentiment and predicting potential price moves based on a clustering of leveraged positions. It uses a heat map visual that highlights the regions where large numbers of long or short positions are likely to be liquidated if price moves to those levels. These zones, marked in brighter or more saturated colors, often neon green or cyan, represent liquidity pockets where significant forced buying or selling could occur. The core idea of the strategy is that price is magnetically drawn to liquidity. It tends to move toward areas where the most liquidations will occur, often manipulated by whales or large players who intentionally drive a market in those directions. For example, if there is a strong liquidity cluster at $93,000 and price is hovering above it, there is a high likelihood that market makers might push the price down toward that level to trigger long liquidations, causing cascading sell-offs and allowing them to fill large buy orders at a discount. Conversely, a cluster around $115,000 might act as a magnet during a bullish phase, luring price upward to trigger short liquidations and fuel momentum. In this strategy, traders observe these clusters on a heat map and align them with price action patterns, such as breakouts, support or resistance levels, or consolidations. If price is consolidating near a heavy liquidation cluster, it's a signal that a sharp move could follow in that direction. However, it's crucial to confirm this with volume spikes or breakouts from structures to avoid false signals. Traders typically do not trade against liquidation pressure unless there is strong structural or fundamental support. Managing risk is a key component. Traders should enter positions with stop losses just beyond the cluster zones and take partial profits as price nears the expected liquidation level. The strategy thrives during trending markets or just before volatility spikes, but during chop or unclear direction, it's better to stay out. Don't forget to like and subscribe.